Hi there, my name is Casey Fulp, CFP. I'm the owner and principal of Carriage Planning. We are a comprehensive financial planning and investment management firm. And I wanted to take a little moment here today as a build on to a video that I previously sent to our clients to talk a little bit about the markets. I'm in the process of working on sort of some bigger ideas as it relates to the economy. But in lieu of some of the recent market activity that we've seen, I thought it might be helpful for you to kind of have a look at what we're looking at, what we see, kind of what may be going on in the markets sort of under the hood. There's plenty of folks out there doing exactly this right now. I would say if any of them tell you with certainty that they know what's going to happen, I'm not here to throw names out, but they're lying. There's no possible way to know what's coming in the future. There are no crystal balls yet to have been invented. However, we can look at the evidence that's available today and recognize what probability might suggest is most likely to occur. Of course, then hedging for or protecting against those events or those types of circumstances that may not be as probable but are still possible. So as far as we see it right now, we are looking at the probability of events. We're going to recognize when evidence changes, when conditions change, when prices change. As far as the market goes, we're completely open to changing our mind. We always are, we always will be, we always have been, and that's something that is important as it comes down to it with investment management. But I think it would be valuable to share these thoughts with you. Hopefully you gain something of interest from it. And of course, if you ever have any questions, please do reach out to Carriage Planning. We'd love to speak with you, whether it be on the investment management side of the conversation or the broader financial planning and wealth management side of things. But without further ado, let's kind of jump into it. All right, so when we're looking at the markets, yeah, we can dive into all the different kind of niches and crevices of the markets, but of course, most people tend to keep their focus on the bigger picture items. The major indices that we watch, whether it's on the ticker tape running across the screen on your news channel, or your application on your phone, you're typically going to find the NASDAQ 100, maybe the Dow Jones, be it the Dow Jones Industrial Average, kind of the old king of market indices, the Dow Jones Composite, or it's oftentimes going to be the S&P 500. Now, are they the best representation of the market as a whole? No, there's no such thing as a best representation. But when it comes down to it, and we're trying to look at what trends are evolving, what types of evidence, again, is presented in the market, we do kind of need to narrow our focus in some regards, and the S&P 500 gives us a pretty nice starting point because it does represent some of the largest, most effective, most impactful companies, highest volumes of trading, the most interest. Like, these are companies out there that, of course, yes, they're blue chip type companies in most cases, not all, but in most cases. They tend to offer a pretty good range of sectors or industries. They all, again, being large cap, they don't necessarily represent the small markets, right? The small companies out there, but more often than not, small and large companies tend to behave in similar fashions in the grand picture, but in the more narrowed, focused, or zoomed in picture, of course, small caps tend to move a little faster than large caps and those kinds of things. But I just want to get it out of the way that I recognize that we're not going to be able to get all the information by looking at something like the S&P 500. But again, we can find what symptoms perhaps or traits are being exhibited by the S&P 500, and then we can extend or kind of protract those observations into the broader equity or stock markets. Today, I'm not going to talk a lot about the bond market, but I do have a little note that I will end on with regards to the bond market. But for now, because there is a vested interest for most people in the stock market, that is where most people's interest lies, that's kind of where we're focusing. So again, talking about the S&P 500, one of the first things I want to bring up is I want to recognize kind of what's been going on since June. Most people know what's happened from January to June. This rather substantial sell-off in most equities, and I say most, I mean, of course, there are little companies out there that have had successful or more success in this market, but by and large, most stocks have been selling pretty aggressively since January. Round about middle of June, we saw that perhaps we had reached a point of capitulation. Now, It just so happens, coincidentally, at that time that there was a lot of talk in news channel, pundit speak and yada, yada, yada about whether the White House was redefining recession. And there was a lot of political back and forth. Political back and forth should not be a surprise to anybody right now. We are in a midterm election year. I warned our clients at the start of the year that one of the big three kind of trends or themes of the year is to be aware of the fact that the political mudslinging and that is going to have a negative effect on markets. But it's also one of those that we want to ignore it as much as we can. It really is irrelevant in the grand scheme of things. It might affect things on a day-to-day basis, but in the grand trends, in the grand scheme, in the grand investors mentality, let's keep those things out of there. But it just so happened that at that same time when the markets were potentially capitulating, we had this kind of war of whether or not we're redefining the term recession. None of that matters. and I offer that to you hopefully to help you sleep better at night. But when it comes to a recession is something much like statistics. Statistics don't apply to the individual. Recessions very rarely apply to the individual. Do effects of recessions, as far as the economy is concerned, do they impact the individual? Sure, they do. Inflation, for example, when it comes to our current marketplace, it isn't affecting you and I, right? That's a big economic issue. It does affect the individual. But as far as a recession goes, whether the GDP is contracting, whether there's other forces that are causing our economy to slow, yes, there are individuals who lose jobs. There are individuals who lose incomes. There are individuals who have a reduction in income, cost of living goes up, whatever it might be out there. But just because there's a so-called recession or not a recession, whatever it is, I would encourage you to focus much more on your personal situation. We are personal financial planners at Carriage House Planning. We look at the personal conditions because by and large, in most historical contexts, there's great opportunities to be had in recessions, just as there are in bull markets and in economic expansion and that kind of thing. So don't get hung up on that. But I bring it to mind not only to make that point of please don't get hung up on the term recession or the definition of recession, because again, in the grand scheme, it's not going to be as impactful to you as, let's just say, maybe your investments are, because they're your investments, they're your dollars. But it just so happened to coincide nicely with the fact that we kind of got this bottoming thing happening. So then the big question came to mind for people, hey, is this it? Are we done with this selling round? Are we done? Is there going to be more pain ahead or not? Before I talk about what's on the screen right here, I'm just going to simply say, I don't think the pain is over yet. The evidence does not suggest that we are done yet. Now that's a bigger picture, kind of 30,000 foot view. As of right now, we do believe that the evidence suggests that we are going to actually have a new low set before we find ourselves at new highs. So to take out this low down here, around 3640 on the S&P, we do anticipate that happening within the course of, let's just say, for loose time frame terminology, let's just put that sometime between now and perhaps the end of 2023. I hate to be vague in that regard. I'd love to be able to pinpoint timing, but again, the evidence currently suggests that we are not done with the selling. But, and this is a big but, what's happening right now very well is what we might deem to be a bear market rally, but it's been a very positive bear market rally. Now I say bear market rally, what does that mean? It means a nice buying opportunity in the midst of what is otherwise a downtrend. We had some pretty solid bear market rallies, believe it or not, in 2007 and 8. We had a few in the early 2000s, but bear market rallies are great opportunities if you're very cognizant, if you have your hands on the controls. It's a way to help offset some of the pain of long-term investing through bear markets. Some of you do invest that way. Some others are more tactical or technical. We tend to be very technical driven in our investment approaches. So for that reason, we aren't hesitant to go to the sideline, let's say, with investments, meaning moving to cash. But there's also certain positions where there is a longer term objective. The workout period or the time frame that we plan to own those investments is a much longer time frame. So we do want to weather the storm through markets like we're currently having. Because again, those monies are intended for something. We can't see the future. We don't know for sure with 100% certainty that this will continue in a downtrend over the big picture. So holding those investments allows us to partake in that opportunity. But again, we're looking at it much, much bigger in terms of broad terms. So we're okay holding through these down periods, because what we're looking at is an EKG in the short term, but instead in the long term you tend to find a much bigger, broader trend from the bottom left to the top right, which is what we want to see with any kind of investment, right? So to look specifically at the charts here, something that is notable in the most recent selling that we saw as we ended up peaking in the middle of August. A lot of people are now sitting there saying, okay, maybe this is it, right? Maybe this is where the bottom falls out. The fact that the market came down to and held this specific mark here, you're going to note here in this little margin note that I have, held the 61.8 Fibonacci retracement. What does that mean? Go back to your grade school textbooks or maybe your high school textbooks, and you might recall an individual with the last name Fibonacci, the Fibonacci sequence, Fibonacci numbers. Fibonacci, not only did he didn't necessarily discover this was existing in nature, this was around other cultures, and other people in the past have noted this observance. However, when it comes down to it, Fibonacci did a nice job of kind of putting pencil to paper when it comes to this observation, and that is there is a very unique natural occurrence of a sequence of numbers if you were to measure certain things in nature. Be it a fiddlehead fern or a nautilus shell, the kind of evolution of things, if you will, tends to show this repeating pattern. And the simplest form of the Fibonacci pattern is if I were to take 0 plus 1, all right, I get 1. But typically the Fibonacci pattern starts at 1, and then I add another 1 to it, I get 2. And then from 2, I take the previous number that I was at, and I add that to it. So if I take 2, I add 1, gives me 3. 3 plus 2 gives me 5. 5 plus 3 gives me 8. 8 plus 5 gives me 13, so on and so forth. And that pattern continues out. Well, if you take that pattern, and then you find derivatives from it, you divide certain numbers by other numbers, you end up getting these percentages that become very almost uncanny in their appearance in market behaviors. At the end of the day, the stock market is a lot like, let's say, an ecosystem. There's a lot of living parts with their own minds, their own psychologies, their own impulses, their own whatever it might be, their own analysis of their environment, just as you would find in a rainforest or a desert. There's predators, there's prey, right? But there seems to be this natural emergence of patterns, just like you see in nature, in the markets, because of the fact that it is kind of its own ecosystem. It has multiple players that all have their own kind of impact on the market. And then as you scale out and you see all those players acting, these bigger trends begin to evolve. One of those trends is we end up seeing that markets have a tendency towards these various levels. In this particular case, this run up, again, from the middle of June until about the middle of August, we ended up seeing a retracement of 61.8% of that move. Now that's an intraday move. So the intraday low all the way up to the intraday high, we ended up retracing. And it just so happens we kind of came down to this mark, and you can see in these very skinny lines here, we came down, touched it, but again, we closed up. We came down, we touched it, we closed up. We came down through it, but we closed just above it, just above that mark. That to us shows a very good sign of short-term strength, right? We're only looking at this specific move. This is only from June until August. That's not a big long-term picture. But in the short term, that gives us a very good kind of a quality observance of strength in the markets for the short term. So for that reason, we have suggested that perhaps we do in fact have another leg up right now in the short term. Let's take that a step further. What I now want to do is bring up, let's see here, the same chart. Again, now we can see this is zoomed out a little bit, but this is that June low. This is up to this August high. Now, I've got this one marked according to closing prices, this Fibonacci, right? But more importantly, I want to bring your attention to these two dotted lines here. The top dotted line is a closing price trend that emerged from that early June, or rather middle of June, up until give or take the start of July. We ended up seeing that there was a close here and here in the middle of July that gave us these two lows. They were ascending lows, right? So we came up, we came back down, but this next low was higher than the initial low, okay? Take that and extend out a trend line, and we can find this is a closing price trend, okay? We violated that. We sold down through that, right? We saw that the market just did not have enough. It came down to it. It quit on this day, right? And ended up having a starting price a little bit higher, but then it blasted down through that line. But what it didn't do is violate the the intraday trend line. Came right down to it and touched it. And it, again, because we know that it didn't violate the 61.8 Fibonacci line, if we were to have not looked at this part of the chart here, right? If back here we were looking at these two trend lines emerging, what I'm going to be focused on is, hey, where do these trend lines intersect Fibonacci retracements? Now, the hardest part about that is I didn't know where our high was yet. So I didn't necessarily have these Fibonacci retracements where they were, but I did at the time have other Fibonacci figures that I could use to, again, I'm looking for confirmation data. I'm looking for signals and confirmation. I'm never going to make a decision on one bit of evidence, one bit of information. I want to see that there is a signal, and then I want to say, okay, is there anything confirming this, right? But I never go into any investment decision going, okay, I want to find confirmation of this, because we can create confirmation, right? We have a bad habit of doing that as human beings. That's where a lot of scientific research goes awry, is the scientist goes in looking for a conclusion. So of course, as they model their studies, even though they're trying to be unbiased, there's an inherent bias inside of that. What I'm trying to do, my best, is to simply say, I don't have an opinion either way. What I want to do is I want to continue seeing more and more evidence of one case being built over another. So in this case, having this intraday price trend not be violated, and it just so happens that it wasn't violated right in line. Again, by the time this downtrend started, I did have a peak. So I ran a Fibonacci trend up to here, right? I could see where my lines are. And I say, okay, where's my closing price trend intersecting these various levels? Where's my intraday price trend intersecting these various levels? Well, of course, it wouldn't intersect back here because I had the high. But I said, okay, I got a 61.8 intersection. Just so happened the timing on that was just about perfect, right? It was just about right there at the beginning of September for a bottom of this small leg of selling. All right, so now I've got a kind of a case being built. I've got some evidence. Let's add a little extra evidence to this. Now again, I didn't go into this looking for the evidence. Instead, what I wanted to do is I wanted to see the evidence kind of formulate itself. Now, I don't typically use Elliott wave theory as a dominant kind of strategy play. Again, this is one where I look to it as a confirmation type of data source. So when I look at the data and I look at an Elliott wave analysis, I won't get into all the details on it. This is a fairly advanced technical pattern. But what we think of when we think of Elliott wave, the kind of rule of thumb that you might take is you think of the dominant trend happens in 5 waves, even though one would suggest maybe a wave is peak to trough. In this case, we would say one wave is up from a starting point to a peak, and then the next wave is down to a trough, and then the next wave is up to a peak. So when it's the dominant trend, if it's a dominant uptrend or a dominant downtrend, you're looking for 5 waves. And then in the interim, you're looking for 3 waves. So a correction per se. Well, it just so happens, if again, I'm going back to that mid-June. Here we are and we're moving up. I've got 1, 2, 3, 4. This is suggestive that we've got this 5th leg that should appear. Now, some of those other rules of Elliott wave, and again, not to get into all the details, but by and large, it really breaks down if 1 or 5 is bigger than 3. The middle leg, that middle leg is really, and this is where kind of the human psychology of things really comes to play, That middle leg is much like the technology adoption cycle that marketing firms like to talk about, where you have the early adopters, you have the mass adoption, and then you have the late adoption right before something phases out. Well, when it comes to the up waves, right? Your middle, this is the bulk of things. This is where the psychology of the investor really dives in. Now, again, we're zoomed in pretty tight here, but this is supposed to be the biggest move. So what that also lends to us is, again, if all of these pieces of evidence are lining up, suggesting that we do have a nice leg up here, what we can derive from this is we should come to or exceed that previous peak on the third wave. So we should come to at least 4320 on the S&P 500. But also what we have to be aware of is the time frame as well as the magnitude. We won't exceed the type of move that we saw from that July to mid-August. So this is not going to have enough, we don't believe right now, to really elevate markets to a critical juncture that we would need to see for a much bigger picture, broader point of view. A little bit more on that in just a second. But again, when we're looking at this, the up wave, technically, if I were to then take this and zoom it in even more, I should have 1, 2, 3, 4, 5 on the up wave, because again, that's the dominant trend. But then on the down waves, I'm supposed to have about a 3-wave pattern. So 1, 2, 3. Very nice, right? That's kind of, again, giving us additional confirmation that this is in fact perhaps what we're seeing. Big up wave, right? 1, 2, 3, 4, 5. All right, so within that leg, that trend, that dominant trend, there's a 5-wave inside of that. And that's what you're doing with Elliott wave analysis, is you're looking for a big one, and then you're going to zoom in. You're going to look for the unique characteristics within each leg or each wave. And then you zoom in again, right? And you can continue to confirm these things. But here on the downside, right? 1, 2, 3. That's what we want to see. Again, that is just building evidence for us. That's the way that we're looking at that. It's building evidence. So the next question is, okay, where are we heading in the short term? Where are we heading in the long term? So to answer that, I am going to bring up one final chart with, again, this Fibonacci retracement. This green line up here, 45, 43, 12. That is very significant for carriage house planning. For our proprietary, what we call our market participation indicator for domestic equities, we would have to get the S&P 500 up to 45, 43 before we feel like we are kind of all clear for a new bull market. We are out of the bear market. It's a pretty good clip from where we are, right? This is the September 9th. I'm doing this on Friday, so hopefully you'll have this, we'll be able to get this out of editing and to you by the end of the day today. But we're down here at 40.34 to get up to 45.43. We're looking at about a 12% gain in the market. Remember a moment ago when I said leg 3 needs to be the biggest in terms of its impact, its magnitude, needs to be the longest and ascend the most to be kind of a classic Elliott wave pattern? That would require this 5th leg to be almost identical to, not exactly identical to, but almost identical to this leg. Is it possible? Yes, it's possible. It could happen. Very well could. But as of right now, the evidence suggests we probably will not get to this level. So, where are we going to go? There's a high likelihood that we're going to maybe top out somewhere right around 4,400. That's what we currently project for the markets, maybe a little bit over. But if we are able to reach that, to us, that's going to be a sell signal. That's going to mean that we should be looking very closely at anything we own in the domestic equity space and looking to very strategically remove those positions from our portfolios. Okay, where are we headed, right? Where is our downside target? Again, if we end up getting this kind of purchasing rally here on the back end of the September, and I'll kind of highlight some timeline issues in just a moment, but kind of where would we be headed? If I were to take the S&P 500, I just brought this up real quick here. Again, we've kind of got all these Fibonacci lines. We've got the green light signal that we would find maybe up here at 45.43. Again, we don't necessarily think that we're going to find that level. The next kind of critical level that we see is undercutting this last low at 36, probably coming down below 3,600. That particular mark, if I were to zoom out here and kind of look back at September of 2020, we had seen the market kind of run up. We saw it sort of hit this level, and there was just something about it, right? The sellers came to be the dominant force. The buyers just didn't have it in them anymore. We saw it recede. We saw it come back up, sort of get back into that territory, sort of test it, receded again. Then it came up and we saw some congestion in here, right? Through November and into December, we saw some congestion right around that 3,600 level. Once we broke out of that though, we had a pretty clean run here until we got around, March, April, May of 2021, which is where the growth value conversation came into the picture, and there were some rough treasury offerings. The inflation conversation was starting to get more public attention. We'd been telling our clients anytime that the Fed was trying to use that nonsense transitory inflation baloney, we were strongly encouraging our clients that we're going to be planning for much higher and much more prolonged inflation. And here we are. We're dealing with that, and that's not a toot toot to our own horn. It's just simply to say, don't trust what the Fed's telling you. They should never be trusted. They should be abolished as far as I see it. But as far as this timeline goes, right, that's kind of what we started to see there. But in the big picture, that 3,600, 3,550 is pivotal. It's an important area to be interested in and where the market very well could head. So then let's talk a little bit kind of broader, bigger picture. In the grand scheme of things, sort of what might be happening. Let's see here if I can get my bigger chart. Bear with me for just a moment here. This is the S&P 500, the same one that we were just looking at, right? Here's our intraday trend support. This is where we were living. There's that August or that June low to the mid-August high. This is where we're trending. Now, notice these dotted lines. This chart's going all the way back to 2010, all right? These dotted lines represent a 15-month cycle, 1.25 years, a year and a quarter. So you would say, what's significant about a year and a quarter? Well, I don't know. And I only say that because there's something about the market that cares about the year and a quarter. Now, how do I come to that conclusion? Well, look back here, starting in 2010, we ended up getting a high on this mark, okay? Now, 15 months later, notice where we are and notice what the market does, right? Consecutive highs just before significant sell-offs. Take that forward into the next year, 15 months later. Now, yes, was there another high in between? There was. But we reached a high that exceeded the previous highs, right? This one ended up tapping out right around the same level, but we reached a new high. We get a sell-off. Those sell-offs are getting incrementally smaller, though, as these 15 months continue. A little high just before a small low. Believe it or not, in 2015, that was a high, but again, the lows came much later in that case. They weren't immediate. But this marked a peak before some selling. We ended up coming up. We get another high and then some continued selling. But notice here in 2017, something unique happens. Every 15 months, we're not getting a high before some selling in the market, some significant sell-off in the market. Really nothing important happens. We're on this upward ascent. 2017, as a quick reminder, was a year that had historically low volatility. It had the most number of days without a 1% correction to the upside or downside. I can't remember the exact statistic, but basically we didn't have like 1% moves to the downside throughout the whole year almost. It was a very easy year to be an investor. And some of that could be due to political decisions that would have reduced regulations during the Trump administration. Some would suggest that it had to do with the easy money policy and the fact that that was kind of the end of easy money lending. Right before in 2018 they tried to raise rates for the first time. Didn't quite go well, at least as far as the Fed's concerned. But let's not get bogged down with that. But let's just acknowledge or accept the fact that in 2017, okay, insignificant. It does become significant though once we were going ahead another 15 months. Now notice something. We get a very substantial low there at the end of 2018, the beginning of 2019. That was the Christmas sell-off, or the Christmas crash, I guess you could call it, in 2018. But then 15 months ahead, where are we? We're in 2020, roundabout March, give or take, right? Of course, we remember that sell-off fairly clearly. Now that we have these two significant lows, this transition becomes relevant. Oh, we were going from a pattern of high, 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 high. Now it transitioned into a pattern. 15 months now is a time when the market marks new lows. Well, let's go 15 months forward into 2021. Nothing significant about that. So what does that suggest? Perhaps we're transitioning again. Perhaps 15-month forward, we'll find we go from this being a low marker to a high marker. Well, why does that matter? Well, it matters because that's going to put us around October 1st, right around the corner. Now, separate analysis, completely separate from this 15-month cycle, had us marking September 15th as a very significant date as far as that fifth wave reaching a high for this short-term trading period before the market begins selling. September 15th to October 1st, that's only 2 weeks. Those two align quite nicely to suggest that in fact, that is where we might begin to mark a new high. You normally think to yourself, a new high is a good thing, right? Well, when it comes to this, no, it's actually a bad thing, right? I would much prefer it we're marking new lows. But again, if we do in fact have this 15-month now becoming a 30-month, if this becomes a transition point, this would mark a high, which would suggest there's some new lows. So as far as timeline's concerned, that is something that we're looking at very closely for our clients. Again, if we can reach certain pivotal marks in terms of maybe getting around that 4,500, somewhere 4,400, which is kind of where we anticipate most of the energy to kind of exhaust itself. Again, if that happens sometime around here, right, October 1st, September 15th, if we can reach there at this point, you may consider selling. You may consider at least getting more defensive. Take some of those risky plays off the table, even if you've got a loss in them, right? Even if you've been riding those things down, thinking, oh, it'll come back, oh, it'll come back. That may be a time where you evaluate and say, okay, is it a taxable account, right? This is where the financial planning comes in. This is where wealth management comes in. The CFP in me immediately starts to say, hey, can we harvest some tax losses in taxable accounts, right? Hey, can we pivot this money into something that's maybe income generating for a short-term period of time? If I've got an IRA account, I can't do anything tax effective, right? There's no real benefits there, but can I free up money for an upcoming required minimum distribution? Right? Maybe I can go ahead and sell something that might otherwise be intended for long term, but it's going to go through some weathering over the next X period of time. Maybe I'm going to go ahead and do my required distribution now for the year. Whatever it may be, there may be some strategy involved there. And that's where, that's what we do for our clients. That's what we're here for. Okay, we've talked a lot about just the S&P. Now I'm going to say, well, why is all this happening? Right? Why did this sell? What's going on? I don't know. Doesn't matter though. Most people are going to point to the Fed. And while, yes, the Fed is responsible in many ways for the run-up in equities, not only from 2020 on, but really from 2008, their policies have been abysmal. Most Americans look at them with a favorable eye because when they act, it tends to favor people immediately. But the detrimental effects of what they're doing are degrading not only to our economy, but they're degrading to our monetary health. And then, of course, there's fiscal health. Congress, we know we can blame, right? Because they have a bad habit of continuing to spend on our future dollars, right? These are our earnings of the future. These are my kids working hard that are going to, as they say, pay, the debts of their fathers. But I don't want to get bogged down with that because there's never one reason that markets do anything. What I want to focus on is what does the evidence suggest? What is it telling us? Now, it's very human for us to want to know why. But again, try to avoid that human inclination, that very natural kind of cognitive bias that you have to say, oh, I want to pinpoint a reason, right? That's what the news does. Well, markets are down today because X, Y, and Z did, ABC. No, that's not why markets are down. That may be a factor, but that's not why. Markets are down because of a billion reasons. And they all happen to converge at various times. And that's when the sellers become stronger than the buyers. But vice versa, the opposite can happen. So don't get bogged down with that. What I will bring to your attention is, even though I don't have a why, what I do have is a very interesting relationship that is not new. This I could trace back much, much further. But the fact is that what happened in 2020 was not a domestic event. Not to say that 2008 was only in the US. 2008 and 9, the great financial crisis, yada, yada, yada. It affected the rest of the world. It did. But it was catalyzed by American behavior and American policies and American institutions. The world institutions had their hand in it, but it was the American markets that created that effect that rippled into the rest of the world. Here we are today, and what happened in 2020 was not uniquely American. So for that reason, the relative spectrum of things matters. So here we are looking at a relationship between the US dollar, the currency's index, and the S&P 500. And we're broadening our scope, right? We're going back to 2018 in the case of this chart. But what I want to bring to your attention is that 2020 event, right? Something very unique occurred there where we saw the dollar weaken substantially. Now, if you'll recall, one of those highlight points of Trump's administration, and it was a point of kind of contention, he wanted a strong dollar policy, but then he wanted a weak dollar policy, and a lot of people, he was going on whatever economists were telling him, and it was noise. It was noise, really. But at the end of the day, there is some effect to be had from strong and weak dollar policies. At the end of the day, don't listen to the politicians. Don't listen to them. Gosh, I can't reiterate that enough. But here we are, and if we see what happened, again, the dollar had run up right there at the start of COVID, and then this massive kind of crash in the dollar valuation. A lot of that was because the US economy, relative to the rest of the world's economies, right? Italy was already kind of shutting itself down. France was doing the same. England was pretty much on the heels of it. Most of the Western world, that's not even to consider China, right? But the Fed came in and said, here's what we're going to do. We're going to print, right? The US economy is producing nothing, but we're going to do the opposite of good monetary policy, which is if you're producing nothing, you're making nothing, you should have less money supply, because that way you have less money chasing less goods. And that avoids inflation. Instead, what we did was quite the opposite. The whole world shut down, right? There's less goods being made available, goods and services. But now let's flood the market with more money, because that's going to magically offset the fact that we shut down our economy. No, all that does is it bakes into the cake inflation. But it also devalues the dollar, because at the end of the day, we don't have backed currencies with anything fungible or physical backing them. What we have is we have fiat currencies. They're backed by the good faith of a government. The government's ability to pay in the future. Well, when they flood the market with currency, guess what the dollar index is going to do respective to other currencies around the world that aren't necessarily getting flooded as much? It's going to collapse. Well, look what's happening with the S&P at the same time, because most people are staying home. They've got this new money that was just given to them for free. There's businesses that were taking out these forgivable business loans where they're not really producing anything because nobody's coming to work. So they're going, okay, we got this money, we got to park it somewhere. We got these, other people staying at home. They've got their E-Trades, they've got their Robinhoods. They're reading online that, hey, look at these meme stocks. Look at GameStop. Look at AMC Theaters. That was the big talk. But all of a sudden, there's all this money and there's very few goods to chase. So where are they going to go? They're going to go try to put it in the market. So you're going to inflate and bubble the market, which is exactly what we saw. But again, recognizing there's this capitulation point here. That's about when other central banks are starting to aggressively begin to try to flood their market or partake in various stimulating efforts on the monetary side of the conversation, meaning money policy, not tax policy, not revenue policy, but stimulatory money policies. Well, in the relative comparison, this is about the time where the US stopped flooding the market with imaginary, the joke in my industry is the Fed printer goes, right? They crank up the printing machine and they just print the money out of thin air. Magic, right? The Treasury printer is printing money and the Fed's going, we're going to monetize that debt. We're gonna be the ones that lend you. Who's we? There's nothing behind them. They're lending on the future ability of the American taxpayer to eventually pay back into these debts. But they stop flooding the market with cash, and guess what happens soon after, right? Oh, turnover. There's a very important inverse correlation between the dollar and the markets as a whole. If the dollar is strengthening, our domestic equity marketplace is likely to weaken. So on the big picture, these are important trends to recognize. Is it why the market is selling? No, it's not why. Again, there's a million reasons why. But is this a very important relationship to monitor? Yes, absolutely. So then we say, okay, let's zoom it in, right? This is a big picture outlook. Let's take it in a little bit and say, okay, what's going on? Aha, notice where we are here, right? These are 30-minute charts. So this is going to take us back. This is September 1st and September 1st here. They're almost aligned on these charts, but notice what's happening. Remember, our markets effectively began the process of kind of turning around right here in the beginning of September, okay? The dollar, there we are, beginning of September, starts this nice arcing pattern where it came up, it found a peak, and down. Now you might notice my two marks here. A close below 108.50 signals the top was probably reached in September of 2022. But a close above 110.25 signals further upside. Well, we got a close above 110.25. However, after that, we did in fact get a close below 108.50. Have we reached a top? Had this not happened, I would say absolutely. But I can't say that for sure right now. I have conflicting signals on the dollar, but I'm watching it very closely. What I can see though is we've got an arcing pattern, right? We've got this nice, rounded up and down, and it just so happens to coincide quite nicely here. So again, I'm looking for confirmation. Is the domestic equity market, does it have a little bit more energy left in it? Yeah, it does. It does. Again, as long as this isn't going to find a spike. Now, it's starting to show some strength again, right? We got to watch that dollar closely. So the takeaway here is, again, we don't know what the future holds, but I'm going to be watching the dollar like a hawk. Because if that dollar starts to reach new levels, if it can come back above that 110.25, I'm going to say, okay, that's just another sign of confirmation that upside energy that the domestic equity markets are experiencing, it's probably run its course, right? We've probably exhausted ourselves. We probably have some selling ahead of us. Okay. I've taken a good bit of time here. What I want to do to kind of finish things off is I want to bring up one last relationship, and then I'm going to parlay that into my final note because I mentioned the bond market. Now, this is our proprietary way of looking at growth and value. A big conversation came up in early 2021. Hey, has growth run its course? Growth stocks, right? These are stocks, depending on how you want to define growth and value, because believe it or not, there is some controversy in how you define growth and value. But growth, by and large, is the growth prospects of either earnings or the potential for the future of this particular company as a growth company. A value company is one that they can't really grow what they're doing. They can't do something different or better necessarily. They might innovate. But by and large, it's a well-established, long trending, they've kind of got their thing and everybody sort of needs it. They tend to pay dividends, right? Those are value. The other way you could define it is they're undervalued to what the market is, or rather the market's undervaluing what they should be worth. but more often than not, value companies are ones that going forward, they're not constantly innovating and changing the game and bringing new things to market that will revolutionize. They're kind of steadfast, tried and true, what they do, banks, financial institutions, that kind of thing. Staples, those tend to fall in the value category. The growth and value relationship, though, the way that we look at it is we're looking at large cap growth and small cap growth at the same time. But what we're trying to do here is effectively try to understand the relationship between the two as one single, let's say, stock, if I were to use that loosely. We're going to look at the chart and say, okay, what can we determine about the psychology of investors, about the trends in the market, about that ecosphere, that ecosystem of the market when it relates to this. So what this is in an uptrend on this particular chart, that's when growth is in favor, right? So we saw that going back again, this is a chart to 2018, moving into 2019. This particular red band is significant simply because we had marked a spot here in early 2018. We came up, we tested it again. We came into this zone, but then we kind of reached this top level. Came down, found that bottom level. It's sort of like a bowling ball going down the lane, hitting the bumpers. So we're hitting bumpers. We come up to this mark, but we crossed through it. That became very important. That was only in April of 2019, actually March, April of 2019. So that was, okay, this bowling lane has been violated, right? The ball jumped out over the bumper. Something's different going to happen, right? We're not going to be playing our game of bowling on this lane anymore. That's kind of how we would look at it. Excuse me. It just so happens after breaking through, we came down, we sat right on that line, we moved up again. We hit a new high in this relationship right at 180. Came down, guess where we came down to? Right back to that line, okay? We went back to that bowling alley and said, no, I'm not going to that lane, right? I'm staying over here. And then, of course, we know what happened in 2020, the stay-at-home stocks, right? The tech stocks, the growth stocks, they ran. But all those staples, all those, standard kind of run-of-the-mill mills, there's a good example, no pun intended on that one, but run-of-the-mill value type of companies, financial institutions, they went, whoa, what's going on here, right? They're flooding the market with capital or cash. The M2 money supply is expanding egregiously. No one's going to work. Who are we going to lend money to? Like, nobody wants to borrow money right now because they don't know what's going on with COVID and everything else. Meanwhile, the Facebooks, the Googles, the Amazons, the Apples, the Netflix, you name it, they're still going headstrong as far as business goes because everyone's still using their products and their services when they're not partaking in the other aspects of our economy because they weren't allowed to, because those people weren't allowed to do business. So we see this mad run up. Well, then I had mentioned 2021, the question came up, growth or value, right? We had some bad auctions. That's when we saw some congestion in the stock markets. Look at this rapid ascent down, right? All of a sudden it was growth is done, right? Value is the new play. But as we often find, you need to have evidence and then you need to have supporting evidence. The supporting evidence really wasn't there yet. It began to surface though. A lot of us, me included, made the early call to begin the shift to value. Did it hurt us in 2021? 100%, yes. Did we miss a lot of that last equity move in like the S&P, which is dominated by a lot of the tech stocks because of the weightings of them? Yeah, we missed out on some performance. We own that completely. But we also recognize that this type of move down to this particular level was a significant one to be very aware of. This kind of move is not something that goes away without a fight. And we saw that growth kind of reassured people. No, we're not done yet, right? We still got energy in us. Don't count us out. Didn't come up nearly to the levels. In fact, it kind of came down up to sort of the previous low band of this particular movement. Came up to it, sat around that 215 mark, played up and down, and then you saw the big rush down. The big rush down happened in October, November, and December of 2022. That alone was a huge red flag, or should have been for most people out there. Anytime growth just completely falls off, it's one thing if value falls off, because value is not growers, it's not expansionary, right? These are tried and true. They're the staples. They're going to be here kind of thing, right? You get a huge fall off like that. That should have been something broke. We got to get away. Carriage House Planning, we did. We got very, very conservative with our domestic equity, and we moved very heavily into commodities at that given time. And we can see here, we broke down through, but we got this congestion. What's going on here? Somewhere in this range of 180 down to about 175. We came back down into our zone though. Look, we're back into this band. And then we moved up, but guess what we came up to? We came up to this 180, this area of congestion. Now, as of right now, this last leg of buying that we currently forecast existing, we don't anticipate that bringing us back above 180. And if it doesn't, that is just another affirmation, another confirmation of our initial suggestion that in fact we do have some additional selling that we need to be preparing for. And for that reason, be aware beware the Ides of March, except in this case, it's like beware the Ides of September, October. Maybe September 15th, maybe October 15th, very critical 30-day period. Then we're right on the cusp of it. So I'm going to finish with a note on bonds. I'm not going to bore you with charts. I've already taken so much of your time. What I simply want to say is there is a lot of evidence mounting now that we are not quite there, but if this is a little reprieve for you, one of the most painful aspects of 2022 has been the fact that stocks have been selling aggressively while bonds have also been getting punished in a way they haven't for 40 years. We've been in a 40-year bond bull market due to the last inflationary cycle that dates all the way back to the late 70s, where in the early 80s, after the Carter administration left the White House, Reagan administration came in, they kept Paul Volcker, a Carter appointee to the chairman of the Fed position. Reagan said, we're going to keep him. I like the cut of his jib, per se. And Reagan said, do what you have to do to get rid of inflation. Volcker said, I'm already going to, don't you worry. And he came out and said, I'm going to break the back of inflation. That's his famous quote. What did he do? He raised rates from what were sitting around the overnight lending rate, mind you, which is the federal funds rate that they lend to banks, and then that transitions into the market. But they took it from about 11% to up to about 22%. They doubled it. But they didn't double it from 1 to 2, right? They doubled it from 11 to 22. It's a huge move. But when rates go up, bond prices go down. So bondholders at that time were not feeling very happy. However, anyone who bought bonds from 1983 forward, rates went down. Now, they spiked up, yes, intermittently, but they had a peak in the early 80s to an absolute trough that they sat at starting in 2008 all the way forward to where we are today, effectively zero. Rates go down, bond prices go up. Well, here we are today. What's happening? Rates are going up. Bond prices have been crushed. That has made this year so painful for investors. And I know it, and I hate it for investors. But there is some hope. There is a strong bit of evidence mounting that even if it's a shorter term move, there is a suggestion that we have some bond bullishness beginning to surface. So if equities do sell off again, this time around, it may not be a, hey, you're lucky if you moved into commodities and you're lucky if you got out at the right time type of decision. It may be much more like the classical equity selling, where you can hedge against the equity losses with bond ownership. That's often been the case in history, right? You can take your money that would otherwise be allocated to equities, you can move it to bonds, or you can balance your portfolio for those of you who like the longer term buy and hold mentality, which I'm not a fan of, but I understand why some people do prefer that. If that's what you're inclined to do, recognize that in fact this time around, there's again, the evidence is mounting that we are going to see some bond bullishness. Now, could that be for reasons of, hey, the Federal Reserve's no longer going to raise rates? They're probably going to raise rates. But raising rates isn't going to fight inflation the way that they're wanting to, or at least they're saying they want to. So we think that the market's pricing in their rate hikes to such an aggressive fashion that when they actually do it, it won't be to that same degree, right? It's like going in and hyping yourself up that the shot's going to hurt really, really bad. I don't want to go to the doctor because I have to get a tetanus shot and it's going to hurt. And then you get there, they put it in. Yeah, it hurts, but you worked yourself up into a tizzy. And then you're like, well, that wasn't bad at all, right? Then you're in a much better mood. we kind of see that potentially happening right now. So that's to maybe give you some hope. With that, I'm going to cut things off. I've hit my time limit. Thank you so much for taking the time to be with me today. If Carriage House Planning can do anything for you, please reach out. We would love to have an opportunity to get to know you a little better and introduce ourselves. And in the meantime, we'll look forward to being in touch in the not so distant future. But while we do traverse this, remember the dollar is very important as it relates to domestic equities, but so is the kind of ecosystem that we have out there, and whether or not these natural occurrences continue to repeat their patterns, we do know that there is some natural, some kind of nature in the markets, and we're going to continue observing accordingly. But best of luck to you, and again, we'll look forward to hopefully talking with you in the near future. Have a great day. Bye-bye.